Why don't you give us a lay of the land, guys? What's going on these days?
Sure, I'll jump in there. You've had kind of a consistent diet of kind of large scale mergers going on in the market, and especially we're talking about the upstream market. A lot of it focused on the Permian, but not all of it. Um, and those have been some of them have closed, some of them are still waiting to close, like Chevron and Hess. But as as these companies consolidate and get bigger, they're seeking out efficiencies and cost savings, and they're also going through a reprioritization of their inventory stack. And so, some of that's taking a little bit longer. There's a lot that goes into a lot of these large scale mergers, and so it's not like a immediate reaction. But you know, I think the trend that we're seeing and hoping to continue to see is this kind of churning out of reprioritization of that inventory and finding the right home for it to the extent it doesn't compete with other items in the newly consolidated entity. And so we're seeing a lot of that. We're seeing people coming back into the upstream space generally, just after the lost decade, so to speak, of not focusing on growth at all costs. Companies have done a pretty good job since the pandemic of focusing on cash flow and living within their means and returning money to shareholders. And so, that's tempered the growth a little bit, but it's invited interest back into the space from investors. And so we're seeing different types of investors looking at it. There's still, some ESG focused folks that aren't interested, but we are seeing capital return to the space in a number of different ways. So that's exciting. And I think that, you've seen some of the private equity funds raise and close funds that are now going to be put to work in the upstream space. So we're looking, I think they're going to be the recipients of a lot of this, asset digestion from the consolidation that's occurred. And then you're seeing other models to come out and buy assets and start companies. John, why don't you kind of fill in on some
Sure.
of the things
I
you've
mean,
seen?
a lot of the same in there as well as the midstream space, and it's just the types of deals that are getting done, in the latter half of this year have been sort of the follow-on transactions from some of those bigger mergers. And so more recently, we've seen kind of a resurgence of acreage trades or maybe farm out type structures where it's bringing in these different types of capitals, whether that be family office money, um, or smaller maybe new management teams from a private equity company, who maybe don't have as big of a commitment but are going to go take down a single pad and kind of prove that they have um, the knowledge and the experience to operate a larger company. And so we're definitely seeing a lot of that happen, which is exciting because it's kind of begets what maybe is coming in the future. Um, and from that, there's a whole host of things that we get calls on to assist with.
Tell us a little bit more about the family office aspect of it. I'm really curious what's different about that and the role they play.
Sure. From at least from what we've seen is, whereas maybe in the past the family offices and maybe still are right are limited partnerships or are limited partners in private equity funds. Now, there are family offices who are taking a slightly different approach, and they want that direct exposure. But whether that be as a non-operated working interest or to directly invest in minerals, but they're just hunting for that yield in a slightly different way with a little bit more hands-on approach. And so we've seen that. We have some friends of mine who are also clients, Buffalo Bayou Resources. They go out and kind of put some of these opportunities together, and really assist family offices in looking at these types of things and underwriting them. And there are other banks too. I know like the Ten Oaks guys, they really help underwrite these types of things, in addition to their brokerage business. But it's just as the capital, it's not like a big secret, right? That, there's less private equity money. In the past couple of weeks, we've seen, Quantum and NCAP come out and announce, and NGP, announce, large, I don't know, I guess NGP maybe hasn't announced yet, but I've heard that they will be announcing, that they're closing a fund. We haven't worked on it, so nothing to disclose there. But it's just different types of capital now that are finding its way into the space, kind of as Austin pointed out.
Yeah. How do you see that? I mean, what is the significant difference? Austin referenced earlier, we went through a season in our industry where it was just throw money at projects. Sometimes we worked projects that just didn't make sense. People weren't as prudent with their investments as we've seen post-COVID. What do we anticipate seeing? We have that shift in mentality. It's, let's make sure we make money. Let's make sure we've got a return. How do you see that continuing to progress? Do you think we'll stay along that more disciplined approach? Or do you see indications that, with administration and economy and all the things that may or may not happen there, do we see any change in that mentality?
Yeah, no, I think that mentality is very much alive, especially at the public company level. I think that, investors, we as an industry needed to earn that trust back. And they've done a great job. I mean, companies have been incredible stewards of capital and have really, really done a great job of living within their means and trying to grow in a calibrated way. It will be interesting to see how these different investors, like the family offices, have a very different cost of capital than, some of the other, especially if they're investing directly versus, having a promote level from a private equity fund. I don't know if that makes, certain projects more investable for that group, going direct than going through the PE route. But, at the same time, it's, PE serves a great function in aggregating capital to be able to do material deals. And they do a lot to, screen investments and find teams and, they bring a lot of value to the table too. So I think, maybe there's a bifurcation in certain, levels of transactions that can be done directly by some of these investors. But I do think that living within cash flow, at least, for material companies is going to, and especially for publics, is going to be very important. And then you have a different, demand dynamic around the world. I mean, that's going to impact pricing. That's going to impact what kind of deal structures people use to do transactions and what transactions can get done based on the basin and based on the, the cost in that basin.
Yeah. We're also seeing family offices and just come in a slightly different, as opposed to just a pure, with a private equity backed team. Instead of them, maybe they can't go get a traditional credit facility. And we're also seeing family offices look at, a way to try to provide sort of a private credit product to bridge the capital or bridge the gap between, the equity dollars they can draw from their private equity sponsor. And then, until such time that they have production online and can put in place a traditional credit product.